What if I told you that two people could invest the exact same amount of money, get the exact same average return over 20 years, and one could end up a millionaire while the other runs out of money completely? It sounds impossible, doesn't it? Well, today we're going to pull back the curtain on the hidden risk that makes this a frightening reality: the sequence of returns. But before we get into the thick of it, just a quick reminder for everyone. This is purely for educational purposes. It's meant to get you thinking. For your own money, it's always a good idea to chat with a qualified financial advisor.
All right, let's kick things off with something I like to call the retirement paradox.
So let's get right to the heart of the puzzle. Imagine two different investors. They both start retirement with $1 million. And over the next couple of decades, they both get the exact same average return. You'd think they'd end up in pretty much the same place, right? But what if one is thriving and the other is flat broke? How on earth is that possible?
Well, the answer to that paradox lies in a powerful and honestly an often overlooked concept that every single person planning for retirement needs to understand. Let's dive in and unpack what we call sequence risk.
So what is sequence of returns risk? In plain English, it's the danger that when you get your good and bad investment years, the actual order of them can wreck your finances if you're also taking money out.
And that's the core idea, right there. It's not just about the average return you get over 20 or 30 years. It's all about the timing. The when is just as important as the how much, especially when you've just retired. The order changes everything. So, you might be asking, why is this such a huge deal in retirement? Well, think about your financial life in two phases. While you're working, you're in the accumulation phase. You're putting money in. When the market dips, hey, that's great, it's a sale. You're buying more for less. But once you retire, you flip into the withdrawal phase. Now you're taking money out. And if the market tanks right at the beginning, that's a disaster. You're forced to sell your investments at a low price just to live, and that's a hole that is incredibly hard to dig out of.
To make this crystal clear, let's walk through a tale of two retirees. This really brings the concept to life.
So, meet Raj and Priya. They're both retiring on the same day with a portfolio of exactly $1 million. And their plan is identical: withdraw $50,000 each year to cover their expenses. On paper, they are starting from the exact same spot.
Okay, now let's watch what happens. In year one, Raj gets lucky. The market has a great year, and even after taking his $50,000, his portfolio actually grows. But Priya, she's not so lucky. The market tanks in her first year. After she takes her withdrawal, her portfolio takes a massive hit. Just like that, a huge gap has opened up between them.
And in year two, it gets even worse. Raj's portfolio continues to do well, building on that strong start. But Priya's portfolio? It's in a nosedive. That gap between them isn't just a gap anymore, it's becoming a chasm. The difference in their wealth after just 2 years is staggering.
And here's why this is so dangerous. When you sell investments from a portfolio that's already down, you are locking in those losses. You're taking chips off the table that can never grow back when the market eventually recovers. It's a double whammy: the market punch followed by your own withdrawal punch.
Fast forward just 5 years. The results are just heartbreaking. Raj is sitting pretty with $1.2 million, his retirement secure. But Priya's portfolio has been decimated. It's been cut almost in half, and she's now facing the very real fear of outliving her money.
But here's the absolute kicker. Over the full 20 years, the market cycles turn. Priya gets a string of amazing years later on while Raj's returns flatten out. And in the end, they both achieved the exact same average return of 7% per year. Identical averages, but wildly different outcomes. That is the terrifying power of sequence risk.
Okay, so I know that sounds pretty scary, but the good news is you are not helpless against this risk. So let's talk about what you can actually do to protect your hard-earned savings.
Now, there are a few smart strategies, but let's focus on 3 key ones. Number 1, have a smart asset allocation. Don't be too aggressive right when you retire. Number 2, create a cash buffer. This one's huge. And number 3, think about being flexible with your withdrawals, instead of taking out the same amount no matter what.
Let's just zoom in on that cash buffer for a second, because it's so simple yet so powerful. If you have, say, 1 to 2 years of your living expenses sitting in cash, you have a safety net. When the market has a bad year, you don't have to sell your stocks low. You just live off the cash and give your portfolio the breathing room it needs to recover. All right, let's bring this all home. What is the one big idea you need to walk away with today?
If you remember just one thing, let it be this. The timing of your investment returns is everything, especially in those first 5 to 10 years of retirement. It's not about the long-term average, it's about the sequence. Those early years can literally make or break your entire retirement.
And so, as we wrap this up, I want to leave you with a question to really think about. Now that you understand the power of sequence risk, take a hard look at your own retirement plan. Is it robust? Is it built to survive a few bad years right out of the gate? Or is it a house of cards, just waiting for a bad sequence to come along and blow it all down?